So today is February 14th. Happy Valentine's Day. It's 8 o'clock on Wednesday, February 14th. And I thought we'd take a look at the mini Dow today in terms of what we're seeing happening in the markets and try to get a feel for what exactly is going on here in relation to predictive indicators. When we look at these markets, we're watching these movements, these phases that we're analyzing here with the daily cycle marker tool are helpful in that they tell us when to expect certain kinds of behavior, right? So there are 4 different phases in the daily cycle marker tool. There's the phase 1, which is the small green dot. There's the phase 2, which is the large green dot. There's the phase 3, which is the little red dot, and then the phase 4, which is the large red dot. And if you get a sense of things, you'll see that in the direction of the trend especially, the signals that are phase 2 tend to be these sort of Herculean pushes up. Phase 1s are even more so the beginnings of large runs up in the Dow. So going all the way back through September after the summer session, so in comparison, what tends to happen when we see the phase 3s and phase 4s? Okay. What historically do markets tend to do in an uptrend when we arrive into a phase 3 or a phase 4? Well, one of the easiest things to do is to just allow ourselves to study the kinds of behaviors that occur around a phase 3 or a phase 4. Okay. And so if we look at these sequences, we'll see that sort of one of 2 things tends to generally happen. And what I'll do here is just sort of, I'm going to take a rectangle from the close of the phase 1 to the close of the phase 2. From the close of the phase 1 to the close of the phase 2. Pull this open. And I'm just trying to get a sense of how reactive the different phases are. And here's the thing. In that same period of time, this one closed lower, this one closed higher, this one closed higher, this one closed lower, this one closed significantly higher, this one closed significantly higher. Pick the wrong color. Okay. It's probably, if anything rather, the health of the uptrend of the market. The health of the uptrend of the market is determined by how willing are people to stop buying the asking price, driving it up higher. They're not even slowing down for this phase one. It only happened really 2 times the entire fall and winter here. And then for the most part, when it was time to slow down initially, there was so much momentum it carried everybody straight up. Okay, now the phase where things do slow down, the phase where things do tend to go into a congestion area on the Dow, really stands out when we look at the phase 4s. So let's take a look at that. So the phase 4 is represented by, on the Dow here today, the large red dot. And one of the things that I think is pretty apparent is that when we come into the phase 4, even in a downtrend, I'm just going to highlight price action between the phase 4 and the phase 1. And does everybody see what tends to happen when we get to the phase 4? The market goes into a range. The market goes into a range, and there is a breaking effect. Let's use the word breaking effect in the uptrend. We do not go higher. It is a pre-planned selling pressure wave of behavior. Okay, picture those the old ropes. What is that? A train brake rope, right? In the old movies, remember when somebody used to reach up and pull that rope and the train would just sort of stop. I don't have any pictures of it here, but in the uptrend, the only thing that really slowed it down, Earl, for a period of time, the only thing that really imposed any kind of diminutive pressurization, just kind of slows it down, candles get smaller, was this phase 4 signal. So in relation to that, I feel like it's important because between the phase 3 and the phase 4, the one that had the most influence, the most ability to apply negative energy, negative pressure, braking pressure, downward force to the Dow, was the phase 4. And that's it. Ever since the collapse of the phase 2 right here, this has been sort of an alert signal that selling is taking over. Selling is taking over, and there's no resumption of buying. No resumption of the buying yet. When we had this signal here, Earl, if we look at all of the prior phase 3s, Earl, this one was punctured before the next phase 4. This one was punctured before the next phase 4. This one was not punctured. This one was not. This one was punctured. This one was punctured. And this one was not punctured. of the two that were not punctured, where the selling just kind of stayed in effect, we'll just leave those two up here. When we got to the next phase 4, price stayed below that swing high. Price stayed below that swing high all the way to here. So in each of these cases, this level was meaningful. This high right here was maintained. This high right here was maintained. So right now, the one that we have up here to reference, this area up here, the 25-250 area, is, in relation to the other two, a swing worth noting. It's a swing worth noting and talking about. Take a quick look here. Okay. So far, so good. So, at the very least, we're expecting, coming into the phase 4, a consolidation effect of at least 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, at least 4 days. Okay, so I'm going to put 1, 2, 3, 1, 2, 3, 4. Okay, so I'm going to have a box over here, Earl, that's somewhere around this size. Where the phase 4 is coming in. Okay, so that's the first thing that I know about the YM. The phase 4 has a breaking effect. Phase 4 is coming in now. When we have an unpunctured phase 3, price tends to stay below the swing high and eventually come back to it, right? So if we look here, there's the prior swing high, and then Earl, it eventually comes over to it. Same thing here. There's the swing high, and it eventually comes over to it. So this level here, the 25-200s, is a level of interest here that we should get to within 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days. Between now and 9 trading days from now, we should come up and see resistance here at the 25-20s. So that means we've got a 250, 500 tick range now, or nearly a $5,000 target away per contract long into the 25-200 area. Okay, everybody with me so far? Just using the information that's on here to get a sense of, to get a feel for what's happening and why. Okay, get rid of everything. Now, there was an article yesterday, I don't know if you guys caught it or not, where a whistleblower came forward and said that he had proof the markets were being manipulated. Let me see if I can find it here. Yeah, here we go. I found this last night. How Wall Street's fear gauge is being rigged, according to one whistleblower. CBOE says whistleblower letter is filled with inaccurate statements. Of course, because if your product can be manipulated, how much trust will people have in it, right? letter makes the claim to regulators that fake quotes for the S&P 500 index, SPX, are skewing levels of the CBOE volatility index, which reflects bearish and bullish options bets 30 days in the future to gauge implied stock market volatility. The flaw allows trading firms with sophisticated algorithms to move the VIX up or down by simply posting quotes without needing to physically engage in any trading or deploying any capital. The whistleblower's claims are consistent with those documented by John Griffin, professor of finance at the University of Texas, and PhD candidate Amin Shams in May of 2017, in research that says the cost of manipulating less liquid XPX options would be more than paid for by a successful bet on the direction of the VIX. The market right now, more and more people, though, Earl, are coming forward and saying, listen, this is happening because of manipulation. Now, it's important to me, it's near to my heart, because I've been preaching this now for 10 years, that these markets are not random and things are happening in relation to the markets, because that's exactly what these large firms and algos and banks want you to believe. So here's what I want you to see. I'm going to save this template and I'm going to reload a new chart. So let's reopen the YM chart. What do we know? If the markets are manipulated, one of the assumptions I make with you is that if we're seeing something happening, it's not the first time that it's happened, right? We had a family emergency over the weekend, pretty significant. I would say it's top 10 most stressful things that I've endured since being married and having a family. Easily top 10. And one of the things that we discussed in relation to the person that was involved, Earl, was a series of behavioral patterns. Okay? What do we know about this person based on what almost always happens with this person in the past? And what we've discovered is, looking at a broad swath of their life, this wasn't the first time they had done what they'd done, and only this time was my family involved. And so we tried to get to the truth by understanding what has this person done before in the past. So here's what I'd like to propose. If we see this pattern right here, where have we seen it before? If we've seen this pattern here, it's the one that allowed me to call this drop in crude and the bounce off the 180 fib the other day. This technique that we're about to deploy is the same one that we used on crude futures that allowed us to understand when crude was going to fall, how far it was going to fall, where it would fall to, and where it would bounce from, resulting in a nearly $5,000 per contract move both ways. 2,500 down, 2,500 up, more or less. 2 and 3, I think. So, Earl, if I'm looking at this pattern, guess what? They've done this before. They believe people are stupid. They believe people are ignorant. They're very focused on the present and don't look in the past. So here's what I'd like to propose. Where in the past have we seen anything remotely similar to that type of a volatile move, right? Where have we seen that large of a drop before? Let's go ahead and measure it, right? Let's look at a couple different measurements. That's 3,500, and I'm going to make this black. And what I'm going to do here, Earl, is measure two different things. I'm going to measure where the high is, and then I want to measure the surge, when the bloodletting occurred. Okay, so 3,500 and basically 3,100. Okay, let's take a look over here where it drops from the fall from grace. Let's call this the fall from grace analysis. The fall from grace. 1/3 of the angels from heaven fell to earth and were condemned to be demons. So when we look here, I'm going to measure the fall from grace, and that was only 1,000 points, right? Nothing really substantial. 1 to 3. Now, here's what I want you to note. It eventually comes all the way back up to the high, from the high. Touches the moving average. There's a similarity here. There's a similarity there. Everybody's freaking out. And Earl, do you notice when that thing happens? Do you see the player here? There's an element of the play. Do you see the phase 3? Right there, the little red line. Little red dot, rather, forgive me. The little red dot. That's right around the time that play occurs. Okay, so look, let's put some elements to it. I want you to see history repeats and sometimes it rhymes, right? There's a phase 2. There's a phase 3. Look over here. I'm going to do the same thing. Here's our phase 2. There's our phase 3. Interesting, right? Big drop. Huge drop in comparison to all the other patterns occurring around the same time off of an all-time new high. Okay, let's add that third component, that third element. Thing drops like a rock off of an all-time new high in relation to prior swings. Higher high, right? Let's use that analysis. Higher high, phase 2 collapse, down into a phase 3, touches the moving average, up we go. So we'll go put a yellow circle around the moving average. So here's the first time we see that, and now the eventual recoupment is a drive all the way back up into the high. Now let's continue and see if we can find another pattern with all of those elements involved, shall we? Okay, where we're up above the MA, and then we have this fall from grace pattern off of a phase 2. Let's see if I can find it. Phase 2, there it is. Everybody see it? Here we go. We're looking for times that the same play was run, or one very similar. And we're going to build a composite. So Earl, here we go. Phase 1, phase 2, phase 3. Moving average touch. Okay. We'll just put the notation in here too. Phase 3. Remember, all of the phases on here are times that we've known about, or we did know about, weeks in advance. Okay, so there's another example, Earl, of that play being run. Very similar approaches, and again, we eventually come back to the high. Let's go back. That's the second example of it. Looking for a phase 1, 2 high with a drop down into the moving average. Now, here's a variant of that pattern. Ready? Check it out. And this one, Earl, has me more concerned because it has a bearish element to it that the other two didn't. Now, why would I be more concerned? In addition to that, Earl, this pattern in 2014 is occurring in February. So they ran this play in a February of 2014. So that instantly pushes it ahead of the line of the other two in my mind. If these things are happening in relation to what we're seeing at the same time of year, that instantly pushes the pattern above my brain, above the other patterns in my brain. Not above my brain, that would be weird. Okay, so this drop was, again, only 1,200 points, 1,300 points, about a third. And that's about the size of the drop that we saw. The elements that we were looking for an all-time high. Okay, in this case, the phase 2 was a lower high. There is a pattern 1, pattern 2 right here. Just like over here, there is a pattern 1, pattern 2. So we'll put the number 2 just so you can see it. And I'm hoping that I can train your eye to see these things the way I see them. There is also a pattern 3 at the very bottom, right here. Earl, that pattern 3 drop is within 1 bar, just like it is over here. Over here of getting near where? That moving average. So I'll put the yellow circle there. Everybody see how that play is getting run? Now, here's the thing. In relation to this February pattern, there is a pullback up into the phase 4, which again we're coming into today. So I'll put the number 4 here, and I'm going to put the number 4 over here, and this is important because it's happening now. It appears, looking at this, that this pattern would suggest a second wave. A second wave down, Earl. Before the drive up. Stand by. I'm going to recalibrate here. One, two, three, four. It's hard for me because the patterns are slightly off, but they're doing the same things. We do eventually come back up to the high. That's the thing that is worth noting. We do eventually make it back up to here. It's not the end of the run. So I'm just going to put the line over here to emphasize that. Okay. But if I look at the February pattern here, it continues to drop down and go down below the MA. Okay, let me just, I'm going to measure something here real quick. Tell me if you follow my logic. I'm going to take Earl, the distance from here to the moving average as my 0 to 100%. And I'm going to do minus 62. Try that. Minus 62, minus 38. Okay, I'm going to change this. I want to get a sense of the proportion below the MA that they drove. There's minus 38. Let's do minus 21. Okay, so that's minus 21. And then I'm going to do minus 30 here as well. Okay, so on the left side, Earl, this is the current one. It dropped minus 21, minus 30 into that low, below the moving average. I'm going to save this as the fib. Okay, Okay, now over here I want to do the same thing. I'm going to come from the high to the MA, and then I'm going to load the fib. Okay. So in this case, I'm measuring the distance from where the high was to the MA, and then I'm projecting down to here the same way I'm doing the pattern here early. You see what I'm doing, Nathan? I'm measuring this distance to the moving average and then an extension of that to see how far down it went below. Before it dropped, before it continued higher. This one has an additional move associated with it. Minus 30. What do you think, Earl? Minus 50? No. 40. 45. Just about 45, yeah. As a matter of fact, let's get super detailed on it. Let's go 43. No, a little bit more. 44. 44. Okay, so Earl over here, I'm going to do the same thing. Excuse me. Minus 44. Okay. So, here's the deal. If these two patterns are very similar, the bloodletting could drop as far as, what is this pattern here? 22, 725, 727. Now, pay attention because sometimes I say things that work out to be really, really accurate. I amaze myself with my own accuracy. So if they choose to run that proportion, we still have room to fall here. And that falling would drive us down now. We are at that point now, this pattern 4 signal now. So let me show you what I mean by that. There are two retracement waves in this pattern, this February pattern. There's the initial drop, Earl. Then there's the first pullback. Let's give that a different color so we can keep track of these more accurately. How about aqua? No, blue. Okay, so first pullback is right here. We'll make that default, and now over here we'll do the same thing. The first pullback, Earl, is here. Okay. Then there was another pullback right there. You see it? And on our chart, the other pullback was there. See it? And then the drop. Drop to the MA. Drop towards the MA. Pull back. Second drop. Pull back. Third drop. All right, I think I got it. I think I figured it out. Thanks for bearing with me with these things. A lot of times it takes me a while to see it, and then I see it, I'm like, I don't know what I am. So here's the first elevator shaft down. First elevator shaft down. Here's the first elevator shaft down. Right here. See it? Okay. First elevator shaft down. Then we have the pullback. I'm going to make that green. Then we have the pullback. I'm going to make that green. Then, Earl, we have the second elevator shaft down. Right here. And over here, we have the second elevator shaft down there. Okay. Can I scoot that over? Yes. Okay. Then we have the second retracement. In this case, it was here. Now over here, God dang it, look at it, man. There's the second retracement, Earl. And then the drop. Can you see it now, guys? If I stretch it out, can you see the proportions of it and how they're very similar? When I draw it with the rectangles, that's when I think it really pops. And again, I might be full of shit. It's very possible. I'm giving you the best that I can see here. But when I compare those two geometrically to each other, in terms of where were the signals coming into it, what are the proportions of the drop, that kind of stuff, it appears that it has the potential to continue to fall and trip out even more stops. There are 3 waves. There are 3 waves of increasing severity. Maybe I can change the colors to emphasize those waves. Let's do red. There we go. Let's do red over here. And then on this one, we'll do like a hot magenta or some crap. There we go. Okay, and let's put the candles up on top of that. You can click on the candles, hold the shift key down in NinjaTrader, and then spin your mouse button backwards, and it'll put those candles on top of whatever you're drawing. There we go. That's a pretty beautiful thing right there. Alright, so with this pattern here, if we go by the 2013, it was 5 years ago, Earl, we come all the way back up. We do come all the way back up. I'm just going to draw a triangle here real quick to signify where that pattern 2 was. I'm going to draw a triangle here to signify where that pattern 2 was. And so this becomes a mirror now. If we look at it that way, this is the center pivot in time. So guys, check this out. Ready? Here's the high. There's the left side of that. And Earl, if I take this triangle now, time-wise, oh, forgive me. Let's get the triangle. And I use it as a time gauge. And I put it over here. I'm going to flip it the other way. Well, hold on. This is what I wanted to do. So I'm going to take that triangle over here, Earl, and I'm going to draw it the other way from the pivot to this corner and go like that. Okay, so timing wise, can you see how it took, we basically got up to the high again in the same time of window that it took us to get down to the low. It took us the same amount of time to get up to the high as it did to get down to the low. So what I'd like you to do is let's keep track of this high. We don't know where the low is yet, but if it follows kind of the way we're looking here, it was much more volatile. If we make an assumption that it's in the next couple days that it drops down, then there's a strong likelihood that we could be back up into the high. I'm just projecting here, this isn't exact. Earl, there's a good chance that we could be back up into the 2600s by how many days? How many trading days from that is it? Excuse me. If this is the center, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So within 2 trading weeks of the bottom, if we hit 22 750s area, 720s, we could be back up into the 2660s within 2 weeks. Does that make sense? But we don't know that yet because we haven't tagged the low. Okay. Any questions about that? And I'm just going to go sniffing one more time just to see. No. No. February, March. Here's a variant of it right here, guys. Okay, so one of the first things, Earl, that I looked down on, I saw this pattern right here that we saw before, right? Green dot, green dot. There's our 2. The 2 is the trigger. Earl, there's the all-time high. phase 1 to phase 2 right there. There's my little green dot in the corner right here. See it? Triangle on the green dot there. My moving average touch is right here. Let's do the elevators, shall we? Let me see what I can find here. First wave, second wave, third wave. 3 waves down. Bounce off of that. Up we go back into the high. Here's the vertical Earl ready. Let's do the triangle. From the high here, down, copy paste. Holy yeah, okay, I got you. I got you. You can't hide. There's the mirror over here. This is 2011 in February, March. Okay, so that elevates it, right? The priority. The February fall from grace. Huge move. This one, I'm going to guess, I'm going to go out on a limb and say it's somewhere around 1,000-point drop. 871. Okay. Here's my question. How many days did it take from the high to the low? Ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19 days was the low. Let's check this one over here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. That's 19 days here. Or let's check the other one that we just did. Just to get a sense of what they did. Okay, ready? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. So this one was 24 days down. Really digging into this one like a tick. That was a 24-day cycle to the pivot low from the high. This one was an 18-day. Okay, so 18 for us would be here. The minimum to get down to there would be that bar. Okay, let's see if we can find one more. So this was 2011. Hang on, the other one was 2014. That's a 3-year cycle. So 2014 to 3 would be 2017. So we're 4 years up. So that's a 3 to 4 year cycle. Okay, I'm okay with it being within a year. Let's see if that's the case. When would the next cycle be? If this last one was at 2014, Earl, we'd want to see something 2011, 2010, right? sorry. 2011 minus 3 minus 4 would be 2007, 2008 February pattern. Okay. Two 2009, 2008, February, March. That's May. I can't go back any farther than that. Let me see if I can load some more data. Yep, I can load more data. 2000, what did we say? 2007, 2008. Holy crap. You can't make this Okay, here's 2007. Earl, do you see it? Ah, okay. All right. Let's fill in some information here. I don't know. Maybe we're completely fooling ourselves here. I don't think so. I don't think so. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So what did we say? The smallest was 18. Let's do 18, 17, 18. Okay, so Earl, there's an 18-day. There's an 18-day cycle here before it reverses up. Okay, let's do our fib thing where we measure from the high to the moving average with our 21, 30, 44 right here by the time it touches. 21, 30. Where's our fib? We'll get our February fib. 21, 30. What was the other one? Minus 44. Okay, so we're going to put the top of the fib at the high. We're going to put the bottom of the fib, Earl, at the MA. Look at that, guys. First wave. First wave here. Second wave here. And I'm not a wave guy, so I'm out of my element with this. A lot of you guys are better than I am with that. Second wave. Third wave. History repeats, but sometimes it rhymes. Third wave down, Earl. Okay. Triangle from the high to where the reversal takes place is here. You could make a case for this too. I'm going to take this triangle and I'm going to reverse it. And we'll flip it the other way. Not quite. Not quite. It took a little bit longer to get there. This is also a February-March pattern. Okay, so the 44 gets tagged in this instance too. So this is February, March. What year is this? This is 2007. 2007. Okay, so 3 to 4. We're assuming this is a 3 to 4 year pattern. 3 to 4 year cycle. Okay, so that's 2007. So the next pattern should be 2010 to 2011. This is 2011. Just trying to build some cohesiveness to this prediction. So this is February, March 2011. So the next one should be 3 to 4 years, should be 2014, 2015. Here we are, 2014. February, March 2014. This was awesome. Did you guys enjoy this analysis? I really did. I'm having a blast. Okay, so 3 to 4 year pattern. The next one should be 17, 18. And that's where we are here. Okay, so graphically, we're seeing this. It's almost like a heartbeat. You guys ever see a picture of a heartbeat? I've been measuring my blood pressure and heart rate and all these wonderful things, and it seems to me this pattern is occurring every 3 to 4 years on that chart. Okay. Fairly predictably. 2003? Do I have data that far back? I have 2005. That's as far back as I can go. 2004. 2004. Can I get any more data? Let me see. File, disconnect, kinetic full, file, connect, kinetic end of day. From grace. Let's see how much further back I got. (2004). That's as far back as I can go. Okay. All right. I wanted to go to 2003 because the pattern here was 2007, so 3 to 4 years. I see sort of a version of it, Earl, here in 2000. In 2005, 2004, February, March. This drop here, but I can't go back any further than that. All right, so that's what we've got. 18 days is down here somewhere. So 1, 2, 3, 4, 5, 6, 7. In the next week or so, we could be as low as 22,727. But a very high likelihood that's somewhere between there and here. We're going to be back up near the highs. Okay, so the retracement to watch for is between 2725 and 2300. This area right here in the YM becomes a historical buy zone. Is there any other evidence for that area? No. Here's the very last thing. Come on now. Stay with me. Can you guys see that right there? There's a resonant angle right there. We'll use a different color so it stands out. There are 1, 2, 3, 4, 5 touches all in that area right here. If I copy paste and come up, man, it's hard to get that one figured out. That one is definitely the resonant angle there though, Earl, right? That means these highs here are not random. So I'm going to run it right through there. Then I get 3 touches if I do that. Okay, so the angles to watch for the retracements. And I'll make sure to post a copy of this workspace so you have it to do your own analysis with. I'm going to come up right here. And my guess is that line is a 50%. Stay with me. I'm going to say that the line above us is a 50% extension of this channel that I'm drawing right here. Let's just do the 50. Yep. Check this out. Yep. So I'm going to come there. So there's a little more reinforcement for that zone, Earl. Right here, down, right here, back up. don't know. Maybe they go straight up from here. I don't think so though. All right. That's enough of that.